Hello, everybody. My name is Stephen Mead with Domicile Real Estate for people who love houses. This is our Southern California housing market update for April 20th, 2021. And this is kind of not clickbait here. One of the things that I wanted to talk about that I've been thinking a lot about is sort of like what's really happening with our market. Why are we pulling our hair out? And if you know anybody in the real estate space, they are probably telling you they're pulling their hair out. And I understand that's not conventional wisdom, right? Conventional wisdom is realtors will always tell you the market is great no matter what's happening. The reality is, though, uneven markets, which is what we're in. We are in a very uneven market, right? Like this is a very, very favorable market for sellers, and it is a very, very challenging market for buyers. Believe it or not, that's not the favorite market for most people in real estate to work in. We like when things are steady and even. Also, I want to talk a little bit about our results this week, and then also talk about what I really think that means for the future and through the summer, and maybe take a slightly longer term look than we're currently looking at. So let me jump into the slides and I'll kind of weave in that longer term conversation that I think we really need to start having. So if we bring up here, let me go back to our beginning. There we go. If we look here at our total listings on the market, we saw a slight jump in our under 1 million, and then it's really just flattened out the past week. We've seen, a very minuscule rise in active listings. And this really tells the story of probably the last year at this point, is that, I think a lot of traditional economists are talking about this swell of new listings coming. And, I think we've seen a couple false starts. We've thought we were going to see that. This is the springtime. Normally, this is a time when we see that inventory level start to grow a little bit, and it's just not happening. It didn't happen last year, and I think the sort of running excuse was COVID. I actually don't think it's COVID. I think, to me, the biggest factor really is that sellers are analyzing where do they have to go and what are their prospects of buying another home. And I think that is having a real damper on people willing to put their house on the market. I think a commonly issued phrase by sellers is, great, I can get X dollars for my house, but where do I go? So we're seeing that here. We're just not seeing the number of active listings really jump. We started to have beginning of the year, and then it just really petered out in both our under 1 million and our under $2 million price categories. Again, this is LA and Orange counties. So if we look here, we look at our last 14 days, our new listings, we've seen an increase, but the reality is we're still looking at the same level of new listings as we had over a month ago. Looking back 2 weeks, like this number hasn't grown. I think we saw a little bit of a trajectory in the spring, and you would have expected, had that continued, we really should be up here somewhere. And guess what? We're not. Even if you look back here, if that had continued, we would have been somewhere over here in our 1 to 2 million. And we're just not seeing these increases in that. And I don't think we're going to, frankly. I think if we hadn't seen an increase in inventory by almost May 1st, I don't think we're going to see a big jump in inventory. That's not to say things might not change a little bit towards the end of summer, or that interest rates could change, or that any number of factors, right, could come in. But at sort of our current situation, I don't see this changing in the immediate future. I don't see a big, gigantic jump. Instead, I see us trailing behind where our trajectory was for this year. So if our new listings is talking about supply, let's take a look at demand, right? And if we look at, actually, there we go. If we look at our new escrows, right, it's really almost a very similar story. We're seeing that supply and demand are operating almost in lockstep with one another. And we're seeing that demand is matching. Every time there's a new listing, there's new buyers there to take it up. When we reconcile our supply and demand, I think that's really where we sort of tell a story of where we've been. This has actually been a shockingly flat curve. And I say that, we're used to things. Look at how things jumped towards the beginning of the year, and now look at where we are. In our under 1 million category, at our lowest point, we have been in the low 80s, and at our highest point, we've been in the low 90s. This is in the past 3 months or so. We are really not seeing a lot of variation in these numbers. And to me, that really says a lot about what kind of market that we are in. We're just not seeing those absorption levels drop. And, as I've been fond of saying, anything, above 80% is a very, very strong seller's market. Anything above 90 is just pretty much nuts. And, you look over the past week here, and we actually saw these numbers grow a little bit in both categories. And I just don't think we're seeing much happening outside of this range. I think there might be some week to week variations. If something happens, like for example, if interest rates jump, that may have an effect on this absorption rate. But the reality is we're just not seeing big variations in these numbers. And one of the things I mentioned was weaving into here a little bit of a story about what I think happens. And talking about interest rates, I really want to play that out for everybody to have an idea what I think might happen. So I think if you're someone sitting on the sidelines right now and you are a buyer, right, your hope is that interest rates might go up a little bit, and that will, of course, reduce demand greatly, which I think it will, and that will result in this plethora of listings and prices will be forced to make some kind of a correction. And I think that's a possibility, but I don't think that's very likely. And the reason I don't think that's very likely is that we are so far down the end of undersupply. Like we're not anywhere near an equilibrium between supply and demand. We really aren't. And because of that, it means that, let's suppose demand shifts. I think what you're going to see is you're going to see a self-correcting system. And what I mean by that is if demand goes downward, I think you're going to see a corollary decrease in supply. And what that's going to do is it's going to stabilize prices. That's going to have a very stabilizing effect on prices. Maybe they drop a tiny bit, like a nominal amount, 2-3%. But honestly, we've had months in the past 18. In the last 18 months, there have been 30-day periods where prices have jumped more than 10%. If it's felt that way when you were looking for a house, that you're not crazy. That is absolutely what happened. I think that it will have a very stabilizing effect on prices, but what it will do, and the hidden effect, is it will lower the number of transactions that take place. So when I think about rising interest rates, yes, I see that slowing demand, but I see it slowing supply. Net result is fewer transactions taking place, not a huge drop in prices. And what is the reason for that? Well, it's the same exact reason we're not seeing an influx of new inventory as prices go up. What we're not seeing happen is we're not seeing sellers rush the market because their biggest concern is, what am I going to buy? I think if sellers see that market get soft, then their concern will be, I'm not getting enough to get to what I want, and I don't want to upgrade and buy up in a market that I think is soft. I think we will see overall just a tightening of that market where less takes place and less is happening. So jumping back into our charts here. So our absorption rate is pretty steady. We're not seeing our market getting substantially easier. If we look at our closed prices, and again, I want everybody to remember that these closed prices are contracts that were negotiated 4 to 6 weeks ago. Our high end of the market, pretty steady. Our median and our entry level markets both saw very, very modest declines. These really aren't enough to talk about. If you look, there's almost a very cyclical nature to these prices. They kind of get run up, then they crest a little bit, then they have another increase. Sometimes these crests are really steep. If anything, I'm actually surprised that we're not seeing a bit more of a fall after some of these increased prices. So if you look here on our median, 2 weeks ago, we kind of had a high point. We didn't see a real backtrack on that. A little bit, but there wasn't the same kind of drop that we've seen following other increases. And I think that really says a lot about our market at the moment. The other factor that's going on is we've seen interest rates actually ease a little bit the last 2 weeks. And I think if we go to our next chart here, this is going to tell you something especially interesting, right? Like, we have a bit of an increase up here, but for the most part, we're still in this common range that we've been in. This is our percent still active after 14 days in the market. And our 1 to 2 million, yeah, the market got a teeny bit softer this past week. if you're going week to week here. But look what happened in our under $1 million entry level market. You know, for the past, that rose up more dramatically, interest rates rising here. And then as soon as those interest rates raise, look what happens. Those properties get snapped up. We are in a market that I believe, especially at the entry level, and if you watched our last first time home buyer market update, I think our entry level market, that demand is primarily being driven by interest rates at the moment. I think entry level buyers are seeing their affordability kind of, they're hitting on limits. And many of those buyers are living and dying by interest rates because that affects exactly what they can qualify for in terms of a home loan. If we look at our close to list ratio, I'm really happy to see my prediction come true. You know, one of the things I talked about last week was I think that my theory is that we are going to see that this 103 percentile area is not sustainable in the long run. And if you think about what this ratio means, I think it's easy to understand. So there's a couple reasons why the close to list ratio goes up, right? It means that prices are rising faster. They are rising faster than sellers are raising list prices. Well, if we see this number start to ease as it has, what does that mean? Well, that means one of two things is happening. Either the buyers aren't bidding up the properties quite as much. I don't think that's what's happening. Or what we're seeing is seller list prices are finally starting to catch up with where the market is at. And that is definitely an effect I am seeing out there. I don't have an average list priced graph to throw up here. I guess I could pull one of those up for you. But what I think is interesting and fascinating about that is, you know, that means that our rate of price increases may be slowing. That doesn't mean the price increases themselves are going away, but the rate of price increases might be slowing, and those list prices are finally starting to catch up with actually where the market is at. We have our days on market for new contracts. Again, we've kind of hit a floor here in our under 1 million of right around 19 or 20 days. That's not changing. We kind of had a floor and we bounced off of that for our 1 to 2 million. But realistically, if you look at these numbers, these are very, very short days on market numbers for new contracts in the marketplace. And remember, because the way days on market is calculated, this is not only the days until it goes under escrow, but the days until it switches to a pending status, which many agents use to mean inspections have been completed. So if you look at that, I mean, really 19, 20 days is nothing. We're still well under 30 days at the 25-day mark here for 1 to 2 million. This is an incredibly fast moving market, and I don't see it. I don't see any signs of that changing. You know, I think there is a hard floor around 19, 20 days. I don't think it can physically happen any faster than that, logistically speaking. And finally, we have our affordability chart. And really, this is going to kind of explain to you, you know, if you're a person on the entry level and you're really trying to get an idea of demand and a proxy for demand, this is a pretty good one. So if you look back here, what you saw was, and remember, just as a reminder to everybody, how to look at this chart. June of 2018 represents our baseline of 100%. And what this is it is the payment on a median priced home as we go through time. So in 2019, it was actually less. In June of 2020, it was less. Then it started to rise, right? As we're in 2021, we've seen these going up, some big jumps, and then a really big upswing here that was driven by both prices and interest rates rising. But look what's happened over the past 2 weeks. This number has dropped. And, you know, we've talked about this before, and I've mentioned it in a couple of other places. You know, my belief is that we probably had around 15% of inflation since June of 2018 overall. And look at where this payment peaked. So, I mean, I don't think we have a huge amount of room for prices to go way up versus where they are today, unless interest rates either reduce further or we see inflation come in, which means wages may actually be increased, right? If inflation comes in, that will actually create room for home prices to go higher, but I'd imagine we will also see interest rates head higher if that is the case. So kind of some interesting stuff going on in our market. And I think you want to be aware of these things, right? And watch what's happening week to week. I wish I could tell you this was a better week than last week if you're a buyer or seller. Really depends on your price range if you're in that entry level market or if you're in that $1 to $2 million market. But the reality is, this is a tight market. It is still a tight market and has been a very tight market for buyers since then. If you're a seller, you're going to get very favorable treatment from the market. Don't overcook your goose list price. I think you might think that you can just list $50,000 higher than the last guy. I don't know if that's necessarily true right now, so be careful. We are seeing that list to close. It looks like we peaked on that. If you're a buyer, I mean, my advice is stay out there and keep at it, right? I think right now, the buyers that are getting offers accepted are the ones that are writing offers, which sounds like painfully obvious advice, but it's true. I think you have to keep a good mental attitude and not really let sort of this, understand this is really a numbers game. You write competitive offers, and with a little bit of luck, one of these times it's going to be your day to get something accepted. Let's see, I'm trying to think if there's anything else I wanted to put on our notes for this week. But here we are, nearly into May. We're not seeing inventory go up. I don't think it's going to go up in the next 30 days. I'm curious to see that list to close ratio, if that continues to fall. Did we really hit a peak on that? And yeah, we will see you this Friday for our entry level buyer market update. We take LA and Orange County, but we focus on that entry level market of condos and single family homes. We actually divide it out. We will see you on Friday. Don't forget to like, subscribe, hit that notification bell. And questions, comments, we love them. Keep coming. And finally, if you need real estate services in Los Angeles, Orange County, reach out to us. We'd love to work with you.